Like, I'm a big fan of physical money. I always have physical money. I fear the day where we go completely cashless. I keep little stores of physical money in the world for in case I ever need it. In a world of only physical money, this kind of credit expansion can't really happen if that's the only money you have without physically printing more dollars. If you had to settle everything at the time with the cash, you can't have this. Am I right in thinking about that?
I think you are, because it's not like euro dollars have any physical form. And that's how they were able to get issued. Because let's say, go back to our British company example. They are issued $1 million loan by Barclays. The next day, they go into their Barclays app and they see $1 million in their account. Then they go to the Barclays branch and they say, can I withdraw 100,000 US dollars? Physical paper currency. The Barclays would say, no, we don't have it. We don't have it. We're not able to give you that. But if there was a physical component to it, Barclays and BNP Paribas and other European banks would have their own printing press with their own little Christine Lagarde face on the middle of the note. And those paper notes would have value in the economy. Let's say companies would accept it because they know that if I take these notes to Barclays, Barclays will credit my account with a deposit. But because it now has a different form, it might have an exchange rate to the dollar, like 99 cents or $1, because there's a market now for physical notes. There would be a black market. Hey, I'll trade you this Christine Lagarde for that Benjamin, and there will be an exchange rate there hand to hand. That exchange rate will make its way into public knowledge because markets are transparent. We know the price of Bitcoin on classified ads on local Bitcoins in different countries. We know it's not the spot price that we see, and we know for a fact that's actually way higher than the spot price because of foreign exchange risk and other risks that are involved in purchasing Bitcoin hand to hand in currency that's not US dollars. Because whoever's selling you that Bitcoin is accepting, let's say, Turkish lira. That seller of Bitcoin doesn't know what that lira is going to buy in terms of dollars in the next hour, in the next 24 hours, in the next 7 days. It has no idea. So it has to charge a 30%, 50% premium just to protect his book from naked exposure and naked losses. I know it's a little bit of a side.
No, but I understand.
Yeah.
I mean, it's like what I was trying to get to is like, if this room was the entirety of the economy and we all had, I don't know, $100 each, and I wanted to buy something for you, this early morning beer, and if I bought it from you and say you sold it me for $10, you would have $110, I'd have 90, but there's still the same amount of money exists. But if I go to you and say, can I buy that beer off you, but can I pay that later? I accumulate the beer, the debt exists, but I still have the money, and then I can go and then spend it with Danny. And that to me is like, that was the real kind of light bulb moment. I was like, this is what creates the credit expansion. And this is what essentially drives the inflation, because it allows us to go and buy other things that we didn't have the money for, which increases the demand on goods. I mean, that kind of like little simple scenario, I was like, I get it now. Now, if you look at what's been happening in terms of global finance of the last, let's say just last 2 decades, even the last 15 years since the financial crisis, it's been that on crack.
Absolutely. And all money is credit money. That's really the world that we live in. All of it is credit money. Anything that comes from a bank, the word deposit itself is credit money. And so the whole system that we have across the world, and for the last, let's say, since 1968, but even going back before that, has always really been a credit money system. It is why people are drawn to Bitcoin, because it's not a credit money system. There is no credit component to Bitcoin. It's a commodity. It's physical money, right? You like physical money. Well, the keys that you have in your wallet, that's physical money too, right? It's abstract, but it is physical because it's yours and it's not a counterparty instrument, layered money, right? It's not a second layer of money. And it's a first layer of money. But for the rest of the world and all the banking system, it's just a credit money system. Now, the credit money system does help finance expansion. It also contributes to the cycle because you have expansion of credit and then you have contraction of credit. So when contraction of credit happens, you have a slowdown in the economy. And when you have an expansion in credit, you have growth in the economy because people are spending. The system that we have today, I don't feel like it's going anywhere. It will stay. Banks are, power players in this world. They're not going to relinquish their position very easily. And it's also why I believe that comparing Bitcoin to the dollar, quote unquote, the dollar, is a terrible comparison. Bitcoin is an asset. The dollar is a credit money system. They're not apples to apples. Bitcoin can be compared to gold like a commodity. It can even be compared to real estate or even stocks. But to compare it to the dollar is a terrible comparison.
Because of scarcity.
Because the dollar has lost most of its definition. Per the Constitution of the United States, the dollar was an amount of gold or an amount of silver, fixed exchange rates. That changed in the year 1900, where they eliminated silver and adjusted the gold price based off of the dollar in 1900. That was a Gold Standard Act of 1900. But since then, and especially once we get into the 50s and then post 1971, the dollar has lost its definition. You cannot, like Jeff Snyder says, you can't describe money. People don't know how to describe money. Try actually defining the dollar. You won't be able to do it in a simple way anymore. The dollar isn't a thing anymore. It's just a denomination of our credit money system. You can't take a dollar and exchange it for anything with the government. It's a Federal Reserve note, first of all. It's no longer a U.S. Treasury instrument. That happened in 1913 when the Fed took over as the central bank of the United States. Before that, paper currency in the United States said U.S. Treasury on top. And it said, I promise to pay the bearer $10 of gold coin on demand. That used to be a dollar. You could define a dollar more easily 120 years ago. But the definition of a dollar is impossible now. So how can you compare Bitcoin to the dollar? What is the dollar? It's a denomination. What is Bitcoin? It's a numeric commodity. So they're very, very different. What is gold? Gold is a physical commodity. So there's a comparison there. What is real estate? Real estate is ownership of property with, scarce, like at least some idea of scarcity. How much land? 57 million square miles. I know that land can be built up or even offshore. These are like little nitpicks of the thesis here that Bitcoin is more comparable to real estate than it is to the dollar. And what about stocks? Stocks represent an ownership over, call it a network, but a company, ownership over the future cash flows of that company. So Bitcoin is ownership of a slice of a network that has utility for the rest of the world. You're not accruing Bitcoin to your own Bitcoin position just because people are using Bitcoin. Maybe the Lightning Network you can, but just for Bitcoin itself, it's a commodity, it's property, it's an ownership claim, but it's not anything to do with credit. And it does have this denomination aspect in common with Bitcoin, and in terms of the dollar and Bitcoin, but that's about where it stops. So I wrote a piece at the Bitcoin Layer a few months ago called Bitcoin and the dollar. What was it called again? The Bitcoin and the dollar are not the same, or Bitcoin versus quote unquote the dollar.
Okay.
And then I did a YouTube video a couple weeks later after it. The thesis here is that compare Bitcoin to gold, stocks, real estate, or even bonds, but don't compare it to the dollar. The two are just completely apples and oranges.
I think the reason people do that, though, is because when they think of money, they think of the dollar. And then when they think of Bitcoin, well, I'm using it as money, so therefore it's comparable. But you're talking about almost the definition of where its value comes from.
So let's go into the word currency.
Yeah.
Currency comes from current, right? Which is a flow. Electrical currents go from one piece of the board to the other piece of the board, right? And then something happens. Currency is the same concept. It's a flow. So the dollar does flow as a currency, as does Bitcoin. So the comparison of Bitcoin to the word currency, I think, is accurate. And comparing the dollar or saying the dollar is a currency is also accurate. So if somebody thinks of this is the dollar currency and this is the Bitcoin currency, they're both called currency. Calling them both currency is appropriate. Therefore, people compare them.
But not money.
What is the dollar? It's not money per se. It's a credit instrument mostly. It's not a commodity. So then when you actually dive a little bit deeper and get out of the word currency and define it deeper, then the comparisons start to fall apart. And I understand that people compare Bitcoin to the dollar all the time because they're both currencies. So it's an acceptable comparison at the surface. But really, when you dig deeper into it, it's not a good comparison.
Can we jump back also and do a little bit of a history lesson here? Talk about Bretton Woods and why it happened. Why did the gold standard end? And what was the benefit to the US being the global reserve currency as opposed to, wasn't there originally pitched like a basket of goods, a basket of currencies? I think there was even a shitcoin named after it at some point. Yeah.
So,
but anyway, so why did it happen?
Oh, I know what you're talking about.
Yeah, and why was it beneficial to the US?
So, the 1929 stock market crash, right? We had the depression in the 30s. What you started to see during that era was countries devaluing their currency versus gold, right? The competitive devaluation versus gold to make their products appear cheaper to the rest of the world to attract demand. So a competitive devaluation around the world in the 30s motivated countries to come together and said, this has to stop. We have to figure out some sort of fixed exchange rate regime. So let's make the dollar the only currency that you can trade for gold. And let's make all the local currencies in France, Britain, etc. Let's make all of those have a fixed exchange rate with the dollar so that the only link between government currency and gold is at the US level. And we're going to stop doing that sort of convertibility all around the world. So from a layered money perspective, gold on the first layer, US dollar on the second layer, and then every other currency on the third layer.
Have you got that, Danny?
Yeah, I think we've got the chart that you did.
We got this prepared.
Or the pyramid.
We knew this was going to come up. And that was done with good intentions, and rightly so. That, I mean, it solved a real problem. Well, competitive gold devaluation was a genuine
competitive
problem.
Gold devaluation was a real problem, but then once you started, this is the one before Bretton Woods, right? This is the convertibility of pounds, francs, and marks and dollars to gold. This is the situation that was before the competitive devaluation.
Okay, so this is just for people listening. We're going to have a few charts up. If you haven't checked out the YouTube, we'll just explain them. But Nick creates these pyramids which explain the layers of money. Hence, Layered Money, his book, and hence the Bitcoin Layer, his company. Now, so this is essentially the layers of money prior to what we're talking about, whereby you have gold at the top, then you have the central banks, and then you have the various currencies. So explain the functioning of this.
Yeah, so if you have, let's say, British pounds in the 1930s, you could take those pounds to the bank or the central bank and exchange it for gold.
Okay.
After 1944, that's no longer the case. Now British pounds only have an exchange rate with dollars, and only dollars have an exchange rate with gold. So you could take your pounds to a gold dealer and purchase gold at the market price, from that gold dealer. But in terms of the redeemability of that note for physical gold, the post-Bretton Woods world ended that. So that only US dollar currency could be exchanged. And that brought in the Triffin's dilemma, the Triffin's paradox, which said, wait, if only the dollar can be exchanged for gold, and what's going to happen to the gold of the US once dollars start stacking up outside of the United States? They're going to take our gold. And it is what happened. And it is why the US and European countries in 1961 started this idea of the gold pool, which was a gold price suppression scheme, basically in a way to keep the gold price from rising. Then in 1968, they basically ended the gold pool because they realized that they wouldn't be able to do it anymore. Right. You can't just print gold.
So it's the expansion of the money which destroyed the gold standard.
It is the singularity of US gold stock being the base, being the first layer of money for the entire globe, that set it up in a way that the lower layers of money expanded so great and the gold stock is only so small that relationship became untenable, and the United States government had to protect their gold stock at a certain point and just say, we have to eliminate the link between gold and government currency. Forget the dollar, just everything, because otherwise we're going to lose our gold. And we're confident we can survive without gold as our first layer of money and continue to be a global powerhouse. And they were right. As 50 years later, the US is still the number one economy in the world, and the margin has probably grown.
But thinking in terms of my analogy, this room is the world. It's you, me, Danny, Jeremy, and Joe. We have $100 each, but we also have our own little central bank of gold. And say we have 5 ounces of gold, and the convertibility is 100 ounces for a gold. So whatever happens, as long as we're spending with each other, and you're receiving your dollars and I'm receiving mine, at any point, if we want to go and get our gold, we can. And that is a perfectly contained system that can't break. But at the point we digitize our money, and I turn around to you, Nick, and say, I want to buy that stuff off you, I'll owe you later, I've created that credit. Now, that credit allows me to go and make a claim on that gold, and at some point that gold will run out. And even though you've got $100, you can't go and claim it. So essentially, that's what we've done on a global scale.
That's right, and that's why that situation ended in 1971. It was an archaic system. It was a sound system in theory, but it broke. And this idea of sound money, and I want to talk to you about this a little bit today in terms of the Fed being, having its response the way that it has this year with hiking rates. But this idea of sound money is an old concept that people are grasping onto today because they realize that this layered money system has nothing at the top that is physical.